Have you ever paused to consider the colossal infrastructure quietly powering our increasingly digital world? Or, how the very ground beneath our energy landscape is shifting?
It's a huge topic right now.
It really is. Today, we're pulling back the curtain on a company that sits, well, squarely at the epicenter of these immense changes, Argan, Inc., known by its ticker symbol AGX.
A really interesting one to look at.
Definitely. Our mission on this deep dive is to truly unpack Argan. We're
Mhm.
going to dissect its unique business model, illuminate its strategic position within a rapidly evolving market,
Mm.
explore the powerful, almost generational trends propelling its growth, and certainly examine the equally significant challenges it navigates in this dynamic, high-stakes industry.
Yeah, those challenges are key.
Absolutely. By the end, our goal is for you to walk away with a truly informed, nuanced understanding of this absolutely critical, yet perhaps, under the radar player in our global energy future.
That's right. At its core, Argan Inc. is what we call a holding company. Think of it as a strategic parent firm overseeing a portfolio of highly specialized operating subsidiaries.
Okay.
These businesses are laser-focused on power generation and industrial infrastructure. Argan's fundamental strength lies in the engineering, procurement, and construction, what we call EPC of large-scale power plants.
Right. EPC. We'll probably use that term a lot.
We will. Historically, they've been synonymous with natural gas-fired facilities,
Yeah.
but what's really compelling now is their rapidly expanding footprint in the renewable energy sector. It's a company with a foot in both worlds, really.
And this is where the picture gets particularly vivid, I think.
Yeah.
Argan isn't just building structures in a vacuum. They are directly shaping the physical manifestation of two colossal global shifts.
Mm.
We're talking about the electrification of everything, which is precisely what it sounds like, a pervasive move towards electricity in, well, every facet of our life.
Yeah, it's everywhere.
And the accelerating transformation of our entire global energy landscape. These aren't just abstract concepts, right? They are fundamental systemic forces redefining how we live, how we work, and how we interact with technology.
Absolutely.
Argan is quite literally building the backbone for that future.
Precisely. So as we journey through this deep dive, we'll maintain a dual perspective. We'll rigorously explore the compelling opportunities that these powerful macro trends present for Argan.
Okay.
But with equal rigor, we'll scrutinize the inherent risks that come with operating in such a capital-intensive, project-driven industry, particularly given the company's predominant contract structure, which, as you'll see, places significant demands on their execution.
Right. Those fixed price contracts you mentioned. High stakes.
Mhm.
Okay, we've got a sense of what Argan does, but how do they do it so effectively in such a, well, cutthroat industry? It turns out it's not a single monolithic entity, but rather a carefully orchestrated network of specialists. Let's pull back the curtain on this holding company structure. How does it actually empower them to thrive, and what's the magic ingredient that stops it from becoming, a bureaucratic mess?
It's a great question, and an important aspect here is how Argan Inc. functions like a strategic umbrella. It oversees distinct operating businesses, but the real power is in the operational autonomy it grants them.
Ah, okay, so they're not micromanaged.
Exactly. They aren't micromanaged. Instead, each subsidiary has the latitude to operate with agility.
So essentially, each piece gets to be a specialist in its own right, like an elite commando unit, kind of able to adapt quickly.
Precisely. That's a good analogy. This decentralized model allows each subsidiary to react incredibly nimbly to its specific market conditions, which is crucial in the construction industry, where local relationships, unique technical expertise, and frankly, a sterling reputation are king.
Right. Trust matters hugely.
Immensely. They maintain their unique brand identities and customer relationships, building immense trust over time. Meanwhile, the parent company, Argan Inc., provides that overarching strategic direction, crucial financial resources, risk management oversight, and robust corporate governance for the entire portfolio.
Got it.
It's the strategic shield and the financial engine, enabling the specialists to do what they do best without getting bogged down.
That makes perfect sense. Each piece of this puzzle has a specific superpower, a specialized capability that contributes to the whole. Let's meet the players, because truly understanding each one is key to grasping Argan's overall strength and diversification.
Absolutely. Argan comprises 4 main operating units, each with a distinct focus and geographic reach. First, and arguably the powerhouse, is Gemma Power Systems, or GPS.
GPS, okay.
Acquired back in 2006, GPS is the cornerstone of Argan's domestic operations and its primary engine for growth within the United States. They are a leading EPC contractor, meaning they handle everything from engineering and procurement to full construction.
The whole package.
The whole package, exactly, specializing in the turnkey design, construction, and commissioning of large-scale power generation facilities. Now, while their historical strength and a track record spanning decades are built on an extensive portfolio of natural gas-fired combined cycle and simple cycle plants.
Which they're known for.
Which they're definitely known for, yeah. But a truly crucial point for the energy transition narrative is their successful and, frankly, rapid expansion into the renewable sector. They're now securing contracts for utility-scale solar and battery storage projects, which showcases a critical dual capability for Argan.
That adaptability seems really key.
It is. Next up, we have Atlantic Projects Company, or APC. This is Argan's international arm, brought into the fold in 2015 with its primary operations centered in the Republic of Ireland and the United Kingdom.
Okay, across the pond.
Right. APC initially focused on the highly technical installation of turbines, boilers, and other large rotating equipment, but they've evolved significantly. Now, they increasingly take on full EPC responsibilities for projects like gas-fired peaker plants.
Peaker plants. Remind us quickly.
Sure. Think of these as the grid's quick response unit, firing up to meet sudden spikes in electricity demand, or filling gaps when, say, the sun isn't shining or the wind isn't blowing.
Got it. Backup power, essentially.
Exactly. And also critical backup power facilities, particularly for the rapidly expanding data center market in that region. Very important there.
Makes sense.
Then there's the Roberts Company, or TRC, also acquired in 2015. TRC provides valuable diversification away from purely power generation. It's an integrated industrial construction, fabrication, and plant services company strategically focused on the southeastern U.S.
So broadening the scope.
Right. They serve a broad spectrum of heavy and light industrial clients across sectors like chemicals, mining, pulp and paper, and general manufacturing. Their offerings range from new plant construction and significant maintenance turnarounds to specialized fabrication services and even emergency response. This arm essentially broadens Argan's addressable market beyond just power.
Important diversification.
Very much so. And finally, the smallest subsidiary, but still a crucial piece of the puzzle, is SMC Infrastructure Solutions, which Argan acquired way back in 2003.
Okay, telecom focus.
Yeah, SMC is a niche provider of telecommunications infrastructure services, operating primarily in the mid-Atlantic U.S. Their services are quite specific. Inside the premise wiring, outside plant cable installation, and sophisticated fiber optic system maintenance for a mix of federal government and commercial customers.
So stable, smaller contracts.
Exactly. While it's the smallest in terms of revenue contribution, it's an important segment because it provides a stable stream of repeatable revenue, often secured through master service agreements, acting as a kind of foundational baseline for the company.
It's clear this decentralized model is a real strength, allowing for highly specialized focus in each area. And it sounds like the parent company doesn't just, sit back. It actively manages risk. For instance, you mentioned a project called Killroot earlier. How did that interaction work?
Indeed. This model is a strength, but it requires robust corporate oversight, precisely for situations like the Killroot project. When APC, the international arm, faced significant operational and contractual challenges with that project, which we'll definitely dig into later, the parent company, Argan, was able to leverage the deep project management expertise and experience of GPS, the domestic leader, to assist APC.
Ah, so they bring in the experts from another subsidiary.
Exactly. This cross-subsidiary support helps de-risk operations and protect shareholder value across the entire portfolio, demonstrating that central governance is far from passive. It's active support.
So we understand the individual components now. How do these specialized strengths translate into Argan overall financial picture? Which segments are truly driving the bus, and what does their recent performance tell us about the company's trajectory?
Right, let's look at the numbers. When we dissect Argan's financial results by segment, the Power Industry Services segment, which is the combined strength of Gemma and APC, is unequivocally the core business. It's the primary engine for both revenue and profit.
That makes sense, given their history.
It does. In fiscal year 2025, this segment alone commanded $693.0 million. That represented a substantial 79% of Argan's consolidated revenues.
Well, nearly 80%.
Yeah. And what's particularly striking here is that this figure represented a remarkable 66.5% increase from the prior year.
66% growth. That's huge.
Huge. This surge was directly fueled by the commencement of several new large-scale projects. It truly underscores how critical this segment's performance and its robust project pipeline are for the entire company's trajectory.
Absolutely. What about the other segments?
The Industrial Construction Services segment, TRC, provides important and valuable revenue diversification. For fiscal 2025, it generated $167.6 million, making up 19% of consolidated revenues.
Still significant.
Still significant, and it showed solid growth too, a 17.4% increase over the previous year. And TRC is strategically positioned for continued growth, particularly within the burgeoning manufacturing and industrial corridor of the southeastern U.S., which is seeing a resurgence due to, onshoring trends.
Right, that makes sense. And the smallest one.
Lastly, the Telecommunications Infrastructure Services segment, SMC, while the smallest, consistently contributes. It brought in $13.5 million, approximately 2% of consolidated revenues in fiscal 2025.
Okay.
As we noted, it's not a primary growth driver, but it offers that stable, repeatable revenue stream often underpinned by master service agreements, providing a reliable foundational base.
And looking at the total consolidated revenues really brings that story of momentum to life for you, the listener. We're talking about total revenues that went from $455.0 million in fiscal 2023, then jumped to $573.3 million in fiscal 2024.
A good jump.
And then absolutely rocketed to $874.2 million in fiscal 2025. That's a massive year-over-year increase of over 52% to get to FY 2025, clearly indicating significant momentum in the business, wouldn't you say?
Oh, absolutely. That kind of jump signals a major ramp-up. Now, understanding how Argan generates this revenue is equally vital. The company predominantly utilizes long-term fixed-price EPC contracts.
Right, the EPC contracts again.
Exactly. To clarify, EPC stands for Engineering, Procurement, and Construction. This means Argan commits to delivering a complete, fully functional project, from the initial blueprint design and engineering, through the procurement of all necessary materials, to the final construction and commissioning for a single, predetermined price.
So if I'm understanding correctly, this is essentially a turnkey solution for the client. They basically hand over the keys when it's done for a price they agreed upon way back at the start.
Precisely. It's a complete turnkey solution.
Yeah.
The implication for Argan, however, is significant. They assume the full financial risk for any cost overruns or schedule delays that might occur during the project's lifecycle.
That sounds risky.
It is. This contract structure is standard for many large-scale infrastructure projects, but it demands incredibly precise cost estimation, exceptionally rigorous project management, and disciplined execution to ensure profitability.
No room for error, really.
Very little. While Argan does engage in other contract types, such as time and materials or cost reimbursable for smaller scopes, fixed-price contracts are absolutely the norm for their major multi-million-dollar projects.
Okay.
The key insight here is that while these contracts offer clients predictability, they place an enormous burden of risk squarely on Argan. It's a high-stakes gamble where precision in bidding and execution aren't just good practices. They're the difference between profit and, well, potentially catastrophic loss.
Okay, here's where the bigger picture truly comes into focus, I think. After years of what felt like stagnation, electricity demand is, well, exploding across the globe. It feels like we're on the cusp of a power infrastructure revolution, doesn't it?
It really does.
What are the biggest drivers of this supercycle that Argan seems perfectly positioned within?
You've hit on a core point. The industry is experiencing a profound reversal of trends. After more than a decade of relatively flat electricity demand in the U.S., roughly from 2008 to 2021, the power generation and construction industry is now entering a period of secular growth, what we are indeed calling a supercycle.
Supercycle, okay.
This is driven by a powerful confluence of long-term trends, fundamentally reshaping how we consume energy. The primary force is a sharp uptick in electricity demand, fueled by the electrification of everything. Essentially, every sector of the economy is increasingly shifting from fossil fuels to electricity.
Right, cars, heating, everything.
Now, the single most significant new catalyst driving this demand is undoubtedly the explosive growth of artificial intelligence and the corresponding build-out of incredibly energy-intensive data centers.
Ah, the AI effect.
The AI effect, exactly. Just think about it. The computational power required for training and running AI models is staggering, and these data centers, which are essentially massive warehouses packed with servers, need colossal amounts of highly reliable electricity.
Unbelievable amounts.
Right. In fact, power availability has actually surpassed network connectivity as the most important factor in data center site selection now.
Really? More important than internet speed.
More important.
Yeah.
Which creates an urgent, unprecedented demand for new, reliable power generation sources
Hmm.
located very close to these new facilities.
That's a huge
It
shift.
is. Beyond AI, we're seeing other major demand drivers. The accelerating adoption of electric vehicles, or EVs,
Hmm.
coupled with federal policies like the HEPS Act, which is funneling billions into bringing semiconductor and battery manufacturing back to the U.S., are creating substantial new concentrated loads on the national power grid.
Right. Factories and chargers all need juice.
Lots of it. And finally, there's the critical component of aging infrastructure replacement. A substantial portion of the existing U.S. power generation fleet, particularly older coal and some natural gas plants, is simply nearing the end of its operational life.
Stuff just gets old.
It does. The North American Electric Reliability Corporation, or NERC, has identified 83 gigawatts of planned power plant retirements over the next decade.
83 gigawatts. That's massive.
It's huge. This alone creates a significant baseline of demand for replacement capacity just to maintain basic grid stability. Never mind the growth.
So if we connect this to the bigger picture, this isn't merely about incremental growth, is it? It's about a fundamental transformative shift in our energy needs, driven by societal and technological evolution. It's a foundational change in how our society functions, making the companies that build this infrastructure absolutely critical to our future.
Precisely. And Argan is strategically positioned not as a pure play in either traditional or entirely renewable energy, but rather as a critical enabler of the entire energy transition. It plays a highly resilient dual role.
How so?
Well, on one hand, there's a growing sort of bipartisan consensus among grid operators and policymakers that natural gas-fired power remains absolutely essential for maintaining grid reliability, particularly in the near to medium term.
Okay, the reliability factor.
Exactly. Modern, efficient gas plants can be dispatched quickly to provide firm power. Imagine it like a backup generator that can switch on instantly and consistently, unlike renewables that depend on the weather.
Right. Solar and wind are intermittent.
Correct. So gas plants can ramp up or down rapidly to back up intermittent renewable sources like solar and wind when they're not generating electricity. This makes natural gas a critical bridge fuel for the foreseeable future, ensuring the lights stay on.
Got it.
Argan's core expertise in this area is, therefore, profoundly relevant.
Still very much needed.
Very much. On the other hand, the market for renewable energy construction is experiencing exponential growth, driven by falling costs and supportive government policies. Solar and wind are projected to surpass coal and nuclear power in the U.S. electricity mix over the coming years.
Big changes there.
Huge changes. Argan, through its Gemma subsidiary, is an active and increasingly successful participant in this market. They have a rapidly growing backlog of utility-scale solar and battery storage projects. In fact, as of the second quarter of fiscal 2025, renewable projects represented a significant $570 million of the company's $1.0 billion total backlog at that time.
Wow. Over half their backlog then was renewables.
At that specific point, yes. It showcases their adaptability and their move into that space.
That's a truly intelligent position to be in, capitalizing on both sides of the energy coin. It offers a kind of strategic resilience, wouldn't you say?
I would.
They're not putting all their eggs in one basket, but rather building both the new green infrastructure and the necessary, reliable supporting infrastructure.
Absolutely. It provides a crucial layer of strategic resilience and mitigates some risk. However, and this is a big however, despite this undeniably strong demand environment, the construction industry faces significant macroeconomic headwinds. Yes. These pose substantial risks to profitability and project timelines, especially for companies like Argan, operating under those fixed-price contracts we keep mentioning.
Right. What kind of headwinds?
Well, for example, since 2022, the industry has wrestled with persistent inflation in key construction materials. Prices for steel, concrete, copper, and specialized electrical components have remained elevated and subject to volatility.
Which hits fixed-price contracts hard.
Directly. It threatens the profitability of those fixed-price agreements. Then there are the persistent supply chain constraints.
Still, even now.
Still, the surge in demand for new energy infrastructure globally has strained supply chains for critical, long lead time equipment. Components like large gas turbines, high-voltage transformers, and specialized switchgear now have delivery schedules stretching out for several years sometimes.
Years. Wow.
Yeah. This has significantly elongated typical project construction timelines from a historical average of maybe 2.5 to 3 years to a new normal of 3 to 4 years, sometimes even longer.
Adds a lot of time and uncertainty.
a lot. And finally, the construction sector faces a structural and deepening shortage of skilled labor. This dynamic drives wage inflation and creates intense competition for qualified workers, engineers, welders, electricians.
Hard to find good people.
Very hard, which again directly impacts project costs, schedules, and overall productivity.
So when you combine these headwinds, longer project durations due to supply chain issues, and persistent cost inflation for materials and labor on those fixed price contracts, it creates a compounding risk, doesn't it?
It really does.
A longer project not only delays revenue recognition, but also prolongs the period during which the company is exposed to unpredictable cost increases. This must necessitate incredibly sophisticated procurement strategies, highly accurate bidding, and maybe even risk-sharing mechanisms within contracts to protect profitability.
You've perfectly summarized the core challenge. The complexity here is immense, demanding a high degree of operational excellence and very careful contract negotiation. Hashtag 3 Argan's competitive edge and financial fortress.
Okay, so in an industry crowded with some truly massive global players, how does a company like Argan stand out? Who are they truly up against in this fragmented, high-stakes market?
Right. The engineering and construction E&C industry is, as you noted, highly fragmented and intensely competitive. Argan competes against a diverse set of players.
Like who?
Well, on one hand, you have the massive diversified EPC firms like Fluor, Jacobs, and Bechtel, which boast global scale and offer services across multiple industries. Big names.
Household names in construction, yeah.
Exactly. On the other hand, there are more directly comparable peers focused specifically on power and heavy civil construction, such as MYR Group, Tudor Perini, and Granite Construction.
Okay, more direct competitors.
Yes. And then, within the rapidly growing renewable energy space, Argan's Gemma Power Systems subsidiary also competes with specialized firms like Burns and McDonnell and SLLV Energy.
So competition from multiple angles.
Definitely. It's important to understand that Argan isn't trying to be a broad market leader. One estimate actually places its overall market share at a modest 0.14%.
Tiny, really, in the grand scheme.
Relatively speaking, yes.
Yeah.
Instead, its strength, its true competitive niche, lies in its dominant position within a very specific high-value segment, constructing large-scale natural gas-fired power plants in the U.S. It's a highly targeted approach, not scattershot.
So what are their secret weapons, then? What truly protects their business from the relentless competition in these niche areas? It sounds like they have to have something special to survive and thrive.
They do. Argan has truly established a durable competitive advantage, a robust moat, if you will, built on several key pillars.
Okay, let's hear them.
First, and arguably most significant, is their niche expertise and decades-long track record. The Gemma Power Systems subsidiary has a proven, extensive history of successfully delivering incredibly complex, large-scale natural gas-fired power plants, including those utilizing the latest, most advanced turbine technologies.
Experience count.
It counts hugely. This history of successful execution on billion-dollar projects builds immense credibility with project owners, utilities, independent power producers, and creates a very high barrier to entry for firms without a comparable portfolio. This isn't something you can easily replicate overnight.
Makes sense. What else?
Second, and this is a truly striking insight and a significant differentiator in this capital-intensive world, is their fortress balance sheet.
Fortress balance sheet. Sounds impressive.
It is. The company consistently operates with no debt. Let me repeat that. Zero debt.
Zero debt. In construction, that's unheard of.
Pretty much. They maintain a massive cash and investments balance, which stood at over $500 million by the end of fiscal 2025. This isn't just a healthy balance sheet, it's Argan's strategic fortress.
How does that help competitively?
Well, in the capital-intensive construction world, this financial muscle is a profound competitive weapon. It allows them to secure the multi-million-dollar performance bonds required to bid on major EPC projects.
Ah, the bonding capacity.
Exactly. That's a hurdle that can easily sideline more leveraged or financially constrained competitors. It's how they stay in the game and win the biggest contracts. That financial strength is crucial.
Okay, that's a huge advantage. Anything else?
And finally, there's their disciplined bidding strategy. Management has cultivated a strong culture of selectivity and risk aversion in its project pursuits.
So they don't chase every project.
No, they don't. The company has explicitly stated its reluctance to enter into fixed-price contracts that it perceives as having an unfavorable risk-reward profile, even if it means foregoing some short-term revenue opportunities.
Patience and discipline.
Crucial for the long term. This disciplined approach is absolutely essential for protecting long-term profitability and, importantly, avoiding catastrophic project losses like those we've unfortunately seen elsewhere in the industry. It's a testament to their long-term vision over short-term revenue chasing.
That makes a lot of sense.
Now, a defining characteristic of Argan's financial profile, one that is both, well, a risk and a validation, is its significant customer concentration.
Ah, relying on a few big customers.
Exactly. On the risk side, in any given fiscal year, a small number of large projects for just a few key customers typically constitute a substantial portion of consolidated revenue. For instance, in fiscal 2025, 3 customers alone accounted for 28%, 13%, and 10% of total revenues, respectively.
Wow, over half from just 3 clients. That is concentrated.
It is. This concentration means that the delay, cancellation, or even the loss of a single major project could have a material impact on the company's financial results. That's the risk.
Okay, but you said it's also a validation. How?
Well, this concentration also serves as a powerful validation of strength. The customers for these multi-hundred million or even billion-dollar projects are not small players. They are sophisticated utilities, independent power producers, and global energy firms with rigorous vetting processes.
The big leagues.
Absolutely. The fact that these demanding clients repeatedly entrust Argan with such critical large-scale endeavors is a powerful testament to its execution capabilities, technical expertise, and financial reliability. It speaks volumes about their reputation.
That raises an important question. How do they manage that dependency, and what does it say about their reputation in the industry? It seems like a high-stakes game where trust is, well, everything.
It absolutely is. Their hard-earned reputation for reliable, on-time, and on-budget execution is their primary defense against that dependency. Building such trust with these demanding clients takes decades of consistent performance, and Argan has clearly earned it.
Okay. Now, let's dive into the numbers themselves. How has Argan's financial journey unfolded over the past few years, and what can we learn from its past performance? It sounds like it's been a bit of a roller coaster.
It has shown some cyclicality, definitely. Argan's financial performance over the past 6 fiscal years truly reflects the inherently cyclical nature of the large-scale construction business. You see periods of revenue decline as major projects wind down, inevitably followed by sharp growth as new, large projects commence.
The project lifecycle effect.
Exactly. For example, fiscal 2020 was a notably difficult year, with revenues dipping to $239.0 million, partly due to issues on a specific project. Performance then rebounded quite strongly, climbing to $509.4 million in fiscal 2022.
Okay, big swing back up.
Right. Then there was a slight dip to $455.0 million in fiscal 2023, as some large projects were completed and new ones hadn't fully ramped up.
A natural pause.
A natural pause, yeah. But then the company entered a significant explosive growth phase, with revenues surging to $573.3 million in fiscal 2024 and an impressive $874.2 million in fiscal 2025. That's that year-over-year increase of 52.5% we mentioned earlier.
Huge ramp up again. What about profits?
Profitability trends have been similarly variable, heavily influenced by the specific project mix and their execution success. Fiscal 2020, for instance, actually saw a gross loss due to those aforementioned difficulties on the T0P project.
A loss, ouch.
Yeah, that hurt. Gross margins recovered strongly to a recent peak of 19.6% in fiscal 2022, before compressing again to 14.1% in fiscal 2024.
Why the compression in 24?
This compression, unfortunately, included the $13.6 million pre-tax loss from the Kilroot project we touched upon earlier. That directly hit the margin.
Ah, Kilroot strikes again.
Exactly. However, in fiscal 2025, as new, more profitable projects ramped up, the gross margin improved encouragingly to 16.1%.
So, heading back in the right direction.
Seems so. Net income has largely followed this pattern, showing strong growth in the most recent fiscal year, reaching $85.5 million in FY 2025.
And for you, the listener, looking at the full table of these numbers really brings the story to life. We clearly see that revenue volatility, but also the consistent zero debt, which is truly remarkable for this type of capital-intensive business.
It really stands out.
The year-end cash and investments have also steadily grown to over $500 million by fiscal 2025, providing that unparalleled financial muscle we discussed.
That cash position is absolutely vital, acting as a crucial strategic asset. When we look at cash flow, the company's operating cash flow is characteristically, well, lumpy.
Lumpy cash flow.
Yeah, it's subject to these significant swings in working capital that invariably accompany large multi-year construction projects. The timing of cash receipts from clients versus payments to suppliers and subcontractors can cause substantial period-to-period volatility.
Makes sense. Timing is everything.
It is. For instance, operating cash flow was a very strong $174.7 million in fiscal 2021, but it naturally declined to $28.4 million in fiscal 2022 as project cycles shifted and working capital was invested. It bounces around.
So, given that lumpiness in cash flow, what's the single most important leading indicator for Argan's future performance? What's telling us what's really coming next for the company?
That would undoubtedly be the project backlog. And here we've seen absolutely explosive growth.
Okay, the backlog. How big are we talking?
After holding relatively steady in the $700 million to $800 million range from fiscal 2022 through fiscal 2024, the company's backlog has grown dramatically. It increased to $1.4 billion by the end of fiscal 2025.
Doubled almost.
And then kept going. Remarkably, it reached an all-time record of $2 billion by the end of the second quarter of fiscal 2026.
$2 billion. That's massive visibility.
It is. This exponential growth provides unprecedented visibility into the company's revenue stream for the next several years, essentially building a strong foundation for future earnings.
Sounds great, but any challenges with that?
Well, yes. This rapid expansion of the backlog also presents a significant operational test. Executing on a project pipeline that has more than doubled in such a short period will require a substantial scaling of labor, procurement, and project management resources.
Right, you have to actually do the work.
Exactly. And the scaling must be achieved within the current challenging macroeconomic environment of high inflation and constrained supply chains we talked about.
Tough conditions to scale in.
Very. While Argan's large cash balance provides a crucial buffer for working capital needs and unforeseen issues, the company's ability to profitably manage this massive increase in workload will be the ultimate determinant of its success in the coming years. It's a testament to their operational capabilities, but also a big challenge to maintain that discipline under pressure. Hashtag 55E. Recent challenges, leadership shifts, and strategic wins.
This massive backlog didn't just, appear out of nowhere. It's the result of strategic wins and successful bids. What are some of the landmark projects that have fueled this incredible growth and truly showcase Argan's capabilities across its subsidiaries?
Indeed, management has demonstrated strong commercial execution, securing a series of truly major contracts that form the backbone of this growth. One key example is the Trumbull Energy Center in Ohio.
Okay, Trumbull.
In November 2022, Gemma Power Systems received the full notice to proceed for this substantial 950-megawatt natural gas-fired combined cycle power plant. This project has been a primary revenue driver for Argan.
A big one.
A very big one. And excitingly, it recently achieved first fire for its turbines in mid-2025, marking a significant tangible milestone toward completion and power generation.
Good progress then. What else?
On the international front, the Irish peaker plants, like the Shannon Bridge and ESB FlexGen facilities, really highlight APC's growing EPC capabilities in Ireland.
Right, APC in Ireland.
In August 2023, APC received notice to proceed for the 264-megawatt Shannon Bridge thermal power facility. These types of projects are absolutely critical for that region's grid stability, especially supporting the rapid expansion of the data center market across Ireland and the UK.
The data center connection again.
Exactly, which, as we discussed, is a huge electricity consumer. These plants help keep those centers running reliably.
Makes sense. What about renewables?
Demonstrating Gemma's successful pivot and adaptability into renewables, they've secured and have been actively executing on multiple Midwest solar and battery projects in Illinois.
Okay, solar and storage.
With notices to proceed received through early 2024, these projects are concrete examples of their ability to capitalize on the changing energy landscape and build out utility-scale clean energy solutions.
So, proving they can do both gas and renewables at scale.
Precisely. And then, a truly landmark achievement that speaks to their future potential. The SLEC project in Texas.
SLEC? What's that?
In February 2025, Gemma announced it had executed an EPC contract for a massive 1.2 gigawatt natural gas-fired power plant for Sandow Lakes Energy Company.
1.2 gigawatts. That's enormous.
Enormous. While this project is not yet fully included in the reported backlog pending a final notice to proceed, it represents a potential billion-plus-dollar addition, a truly massive future opportunity for the company that could propel future growth even further.
Wow. Potential game changer down the line.
Could be. And just recently, in July 2025, APC further solidified its position in the competitive Irish market by executing an EPC contract with SSE for approximately 170-megawatt open-cycle gas turbine plant, the Platin Power Station, showing continued momentum there as well.
What's truly striking here is the sheer scale of these projects and the diverse energy solutions Argan is providing. They're not simply building one type of plant. They're constructing the entire spectrum of what a modern, resilient energy grid needs, right? From massive gas plants to cutting-edge solar and battery storage.
That's a great way to put it. They're building the portfolio for the modern grid.
But as with any major construction firm, it hasn't all been smooth sailing. The industry has inherent risks, and Argan faced a significant test with the Kilroot project, which really brought those challenges into sharp focus. Can you tell us more about that specific instance?
Absolutely. The Kilroot Power Station project in Northern Ireland, managed by the ATC subsidiary, serves as a crucial, if painful, case study in the inherent risks of fixed-price EPC work.
Okay, the cautionary tale.
Pretty much. The project was unfortunately beset by a cascade of significant operational and contractual challenges. These included unforeseen supply chain delays for critical components, material changes to the project scope requested by the client midstream.
Uh-oh. Scope creep.
Exactly. And as a direct consequence, rapidly escalating costs and impacts to the construction schedule. These issues ultimately culminated in a material pre-tax loss of approximately $13.6 million, which Argan recognized during fiscal 2024.
$13 million. That's a significant hit.
It is. This loss directly and negatively impacted Argan's consolidated gross profit and net income for that year, underscoring the high-stakes nature of these contracts we've been discussing.
So how did they respond?
Well, in response to these significant challenges, Argan's management took decisive and swift corrective action. They initiated a comprehensive operational review of APC, importantly, leveraging the deep project management expertise of the more experienced Gemma Power Systems team to enhance APC's processes and improve future profitability and risk mitigation.
Using that internal expertise again.
Right. This incident reinforces that even well-managed companies face these complexities in large-scale construction. And Argan's response demonstrates their disciplined approach to de-risking operations across its subsidiaries by sharing best practices and intervening strategically when necessary. It's a clear example of how that holding company structure can provide support and enforce standards.
Okay. Beyond the ebb and flow of projects, the company itself has undergone some significant changes at the very top. What does this leadership evolution mean for its future direction and how it operates moving forward? Seems like a bit of a transition period.
This period has indeed seen significant changes at the corporate level, signaling a new chapter for Argan. In a pivotal leadership transition, founder Rainer H. Bosselman, who had guided the company for decades, retired as chairman and CEO in August 2022.
End of an era.
Definitely. He was succeeded by David H. Watson, who now serves as president and CEO, marking a clear generational shift and ushering in a new era of leadership. There was also the planned retirement of the chief financial officer in August 2024, with a robust succession plan already in place for that key role, ensuring continuity.
Good planning there.
Seems so. And in February 2025, Argan strategically relocated its corporate headquarters from Rockville, Maryland to Arlington, Virginia, a move intended to centralize and streamline its corporate functions, reflecting perhaps a more modern operational approach.
Interesting. So new leadership, new location.
Right. These shifts indicate a deliberate evolution in how the company is managed and positioned for the future. #TechChevV, capital allocation and shareholder value.
A company's financial decisions, particularly how it allocates its capital, truly reveal a lot about its core values and long-term strategy, don't they?
They absolutely do. Actions speak louder than words.
So how does Argan prioritize its capital, and what does that say about their overall approach? Is it aggressive growth or something else?
Argan's management team has a very clear, consistent, and I'd say disciplined approach to capital allocation, which they explicitly articulate. Their priorities are ordered as follows.
Okay, number one.
First, they focus on investing in organic growth to support its operating subsidiaries. This means reinvesting in their existing businesses to expand capabilities or capacity. Internal growth first.
Makes sense.
Second, and this is a strong signal to investors, they are committed to paying a regular and growing quarterly dividend.
Returning cash to shareholders.
Directly. Third, they will opportunistically repurchase shares when they believe the stock is undervalued or perhaps to offset dilution from stock plans.
Buybacks. Okay.
And fourth, they will consider strategic mergers and acquisitions, M&A, that specifically complement existing skills or expand their geographic footprint, but only if it's the right fit and presumably the right price.
So M&A is last on the list.
It appears to be. This is a very shareholder-friendly and, frankly, conservative approach, prioritizing a strong balance sheet and direct returns over potentially aggressive, potentially dilutive M&A or ill-advised acquisitions. They seem cautious.
And how has that disciplined approach actually translated into tangible returns for those who choose to invest in the company? Are they truly walking the talk when it comes to returning capital?
They absolutely are. Returning capital to shareholders is indeed a core component of Argan's strategy, and they have a long, consistent history of paying quarterly cash dividends.
Okay.
And in a strong signal of management's confidence in the company's future earnings and cash flow, the board has approved multiple significant dividend increases in recent years.
Like how significant?
Well, for instance, the quarterly payout was initially raised from $2.25 per share to $0.30 in October 2023, then up again to $0.37 in September 2024.
Steady increases.
And most recently by a truly significant 33% jump to $0.50 per share in September 2025.
Wow, a 33% hike? That's a statement.
It's a big statement. This isn't just a token gesture. These kinds of increases demonstrate sustained confidence in their financial outlook.
Definitely. What about the buybacks?
In addition to dividends, the company has maintained an active and frequently expanded share repurchase program. The authorization was initially $25 million, then increased to $50 million in January 2022, and subsequently more than doubled to a substantial $125 million in December 2022.
So they're putting real money behind it.
They are. Since the program's inception in November 2021, Argan has effectively returned over $100 million to shareholders through share buybacks. This action effectively reduces the outstanding share count, which in turn tends to increase earnings per share and enhance the per-share value for remaining stockholders.
Another sign of confidence in their own stock price.
Exactly. It's a clear signal of management's belief in the intrinsic value of the company.
Now, you mentioned M&A was lower on the priority list. How did they build the company initially then? Weren't some of these subsidiaries acquired?
That's a great point. Looking back at Argan's history, its current successful corporate structure was actually built through a series of strategic acquisitions. Key subsidiaries like Gemma Power Systems, Atlantic Projects Company, and the Roberts Company were all thoughtfully brought into the fold via acquisition.
So they used to be more acquisitive.
Yes. The overarching strategy at the time was to acquire well-run companies in adjacent markets, providing them with the necessary capital and strategic oversight to grow, while crucially allowing them to maintain operational independence and their unique market identities. This was how the family of specialists model was originally formed.
A buy and support strategy.
Exactly. However, the company's M&A activity has been relatively muted in recent years, especially on the larger scale. The most recent transaction was a relatively small bolt-on acquisition in December 2021 aimed at expanding the geographic footprint of the SMC telecommunications subsidiary.
Just a small tuck-in.
Right. The lack of major acquisitions since 2015, coupled with their stated capital allocation priorities, suggests a deliberate strategic pivot. Management is now clearly prioritizing organic growth within its existing successful subsidiaries and consistent direct shareholder returns over large-scale M&A.
Especially if prices are high.
Especially in a market with potentially high acquisition multiples that might not offer compelling value. This really underscores the management team's disciplined and conservative approach to capital stewardship. Focus on the core, reward shareholders. #ZVOL, strategic outlook and growth trajectory.
Okay, looking ahead now, with all these dynamics at play, the super cycle, the risks, the balance sheet, what are the big engines that will truly drive Argan's revenue and earnings in the coming years? What should we, and you the listener, be watching for?
Right, the catalyst. Well, the most immediate and significant catalyst, providing almost unprecedented clarity, is the profitable conversion of a company's record-breaking $2.2 billion project backlog into recognized revenue.
Job number one,
Go.
execute the backlog.
Absolutely. The sheer size of this backlog provides a clear and robust path to substantial top-line growth over the next 2 to 4 years, giving management incredible revenue visibility. It's essentially revenue already secured, just waiting to be executed profitably.
Huge potential there. What else?
Beyond the existing backlog, the pipeline of potential new project awards remains exceptionally strong. This is fundamentally driven by the urgent, almost insatiable need for new power generation to support grid reliability and, as we've discussed, the ever-growing demands of AI data centers and electric vehicles.
The macro trends are still blowing strong.
Very strong. A crucial future catalyst, one that could add another dimension to their growth, would be securing a full notice to proceed on that massive 1.2 gigawatt SLEC project in Texas.
Right, the big one in Texas.
Which, as we discussed, represents a potential billion-plus dollar addition to the backlog in a single stroke. That would be a major win.
Definitely something to watch.
Additionally, the Roberts Company, in the industrial segment, is strategically positioned to benefit from the ongoing trend of manufacturing onshoring and increased industrial capital expenditures across its core market of the southeastern U.S., providing a strong non-power-related growth vector as well.
Good to have that diversification contributing too.
Absolutely.
Now, growth is certainly good, especially in this environment, but what about profitability? How can they boost those gross and operating margins in such a challenging inflationary environment, particularly with those, tricky fixed price contracts?
Yeah, margin expansion is key. Improving profitability will indeed be a major focus and a determinant of success. Several factors could contribute. First, a more favorable project mix could play a role.
How so?
Well, gross margins are highly dependent on the types of projects Argan is working on. A higher proportion of complex natural gas-fired power plant projects typically command higher margins than certain renewable projects, just due to complexity and risk. So if those larger, more technical projects dominate the backlog as it converts, that could naturally lift the company's overall gross margin profile.
Interesting. What else?
Second, a primary focus for margin improvement is ensuring improved execution at APC. This involves a critical focus on the successful implementation of enhanced project management controls at the Atlantic Projects Company.
Learning the lessons from Kilroot.
Exactly. Avoiding a repeat of the financial losses incurred on projects like Kilroot is absolutely crucial to improving consolidated profitability and regaining consistent higher margins from that international segment.
Makes perfect sense. Any other paths to bar margins?
And third, as the massive backlog drives significant revenue growth, Argan should benefit from operating leverage.
Explain that quickly.
Sure. Selling, general, and administrative, or SG&A expenses, that's essentially the day-to-day operating costs not directly tied to project construction, like corporate salaries, marketing, office expenses.
Overhead, basically.
Right, overhead. Those costs are expected to grow at a much slower rate than revenue, especially with such a large backlog. This should allow a greater portion of gross profit to fall to the bottom line, thereby expanding operating margins across the entire company. More revenue over a relatively fixed cost base.
Got it. Scale helps profitability.
If managed well, yes. Now, while Argan is steadfastly focused on its core competencies, there are also avenues for expanding into new markets, both geographically and in terms of services.
Like what? More M&A after all.
Possibly, but maybe smaller scale. The holding company structure itself is actually quite well suited for opportunistic M&A. While not a recent priority, a strategic, well-vetted acquisition could allow Argan to efficiently enter new, high-growth geographic markets for either its power or industrial services, bringing in complementary expertise, perhaps.
Okay.
Additionally, the company is already leveraging the existing skills of its subsidiaries to enter adjacent end markets. For instance, the Roberts Company is applying its industrial construction expertise to projects in the rapidly growing data center and water treatment sectors.
Applying existing skills to new related areas.
Exactly, thereby expanding its addressable market beyond traditional heavy industrial clients. This kind of organic adjacent expansion is a smart way to grow without necessarily the bigger risks of large-scale M&A. #TAG7, comprehensive risk assessment.
Okay, no business, no matter how well-run or strategically positioned, is without its challenges. Especially in an industry this complex with massive projects and long timelines. What's the biggest risk looming over Argan that investors and our listeners should really be aware of?
You've identified the core vulnerability. The most significant risk facing the company is deeply embedded in its primary business model: project execution and fixed-price contract risk.
Back to those contracts again.
We have to keep coming back to them. Argan's reliance on large, long-term, fixed-price EPC contracts means it bears the full financial risk of cost overruns, schedule delays, and unforeseen technical challenges.
If things go wrong, it's on their dime.
Entirely. If the costs to complete a project exceed the contracted predetermined price, the company's profitability is directly and negatively impacted. The recent $13.6 million financial loss on the Kilroot project, which we discussed,
It's a cautionary tale.
is a clear and material example of this risk manifesting in a significant way. It vividly demonstrates that even a disciplined and well-managed company is not entirely immune to the inherent complexities of large-scale construction. It's just part of the business.
A constant risk factor. What else?
Beyond project-specific risks, there's economic cyclicality and end market sensitivity. The market for new power plant construction is inherently cyclical, tied directly to broader economic conditions, the pace of electricity demand growth, and even energy commodity prices.
So a recession could hurt them.
Potentially, yes. A significant economic downturn, or maybe a major shift in energy policy, could lead to a reduction in capital spending by utilities and independent power producers. This, in turn, could result in the delay or outright cancellation of projects within Argan's pipeline and backlog.
Even projects they thought were secure.
Possibly, which would have a direct adverse effect on the company's revenue and profitability. They're tied to those big capital cycles.
Makes sense. Any other financial risks?
Then there are specific financial risks, particularly that customer dependency we talked about, and the lumpiness of backlog conversion.
Right, the concentration.
As we mentioned earlier, the company consistently derives a large percentage of its revenue from a small number of customers in any given year. While this often signifies strong relationships, it also means that the loss of a single major customer or a significant reduction in that customer's capital spending could have a material adverse impact on Argan's financial health. It's a key vulnerability.
And the backlog conversion.
And while the project backlog is a critical indicator of future revenue, it is not an absolute guarantee. Projects included in the backlog can be delayed for extended periods or, in some cases, even canceled by the client due to external factors beyond Argan's control.
So the $2 billion isn't cash in the bank yet?
Not at all. The unpredictable timing of when backlog converts to revenue can lead to lumpy and volatile quarterly results, making short-term forecasting quite challenging for analysts and investors.
Okay. What about broader external threats?
Finally, Argan faces various broader regulatory, geopolitical, and operational threats. The power industry is heavily regulated, so changes in environmental laws, shifts in energy policies, perhaps favoring one fuel source over another.
Politics can interfere.
Definitely. Or even delays in the project permitting process could significantly impact the economic viability and timeline of new power plant developments. Furthermore, the imposition of tariffs on key construction materials like steel or specialized electrical components can increase input costs and create considerable uncertainty in project budgeting.
Trade wars and things like that.
Exactly. And as we've seen, Argan remains exposed to ongoing global supply chain disruptions for critical equipment and persistent shortages of skilled construction labor. These external factors are largely outside of the company's direct control.
Hard to manage things you don't control.
Very hard. But they represent significant operational risks that can negatively impact project costs and schedules, even with the best planning. It's a complex web of risks.
Okay, after all this in-depth analysis of Argan's business, its competitive advantages, the supercycle tailwinds, and of course the significant risks it faces, how does the market actually value the company right now? Especially when you compare it to its competitors in this rapidly evolving space. What are investors thinking?
Right, the valuation question. A comparative analysis of valuation multiples provides essential context for how the market is currently pricing Argan relative to similar companies in the engineering and construction sector.
Let's look at the numbers.
As of mid-September 2025, Argan traded at a trailing 12-month, or TTM, price-to-earnings ratio of approximately 27.7 times.
Okay, PE around 28.
A price-to-sales ratio of about 3.4 times, a price-to-book ratio of roughly 8.1 times, and an enterprise value-to-EBITDA ratio that's EBITDA of approximately 18.0 times.
Okay, so those are the metrics. What do they mean compared to others?
All right, let's dig into what the market is telling us. If we compare these metrics to its peers, Argan's valuation appears to be at a premium.
A premium, so more expensive.
Relatively speaking, yes. For instance, MYR Group, another specialty contractor with some similar operations, has recently traded at an EV/EBITDA multiple in the range of maybe 16.6x to 17.6x. Granite Construction, a larger, heavy civil construction firm, has traded at an EV/EBITDA multiple of around 13.8x.
So Argan's 18x is definitely higher than those.
It is. The multiples for Tudor Perini, another competitor, are less directly comparable due to recent periods of negative earnings and EBITDA, which actually highlights Argan's stronger financial position in comparison.
Okay, so why the premium for Argan?
What did that premium really mean? It's the market's way of saying, we believe Argan is special, or at least specially positioned right now.
All right.
They're assigning a higher value not just to Argan's significant growth prospects in this energy supercycle, but critically to that fortress balance sheet, that zero debt we keep coming back to.
The zero debt factor again?
To their disciplined bidding, and to their proven track record of execution. It's as if investors are willing to pay more for the perceived safety and quality of Argan's earnings stream, especially given the growth outlook.
So it's not just about potential growth, but also about the quality and perceived reliability of that growth. backed by that strong financial foundation.
Precisely. And what's important to note here is that these current multiples aren't just higher than its peers, they're also elevated compared to Argan's own historical valuation ranges.
Higher than usual for Argan itself.
Yes. This signals a palpable shift in market sentiment, reflecting a heightened optimism about the sustained demand for energy infrastructure and, of course, that record-breaking $2.2 billion backlog. The market is very bullish right now.
Okay. So what's the key question for listeners then?
The central question for you, the listener, as an informed observer, is whether this growth and margin profile is sustainable beyond the current, highly visible project pipeline, and if the current stock price adequately discounts the significant operational risks we've outlined.
Is the optimism justified, basically?
Essentially, yes. A premium valuation often implies very high expectations for near-flawless execution, leaving little room for error. It suggests investors are confident that Argan can navigate those risks successfully and deliver on that backlog profitably.
High expectations built in.
Definitely. And for you, the listener, looking at the table of these comparative valuations visually reinforces that Argan, Inc. indeed stands out with some higher multiples, especially when you consider its robust and growing dividend yield compared to some of its peers. It suggests a balance of growth potential and shareholder returns is being valued by the market. Hashtag AGX, management quality and governance. Now, turning to the people running the show, Argan's leadership has undergone a significant and deliberate transition in recent years, moving from its long-tenured founder to a new generation of executives.
Right. The founder retired.
Exactly. This is a critical point for any company, signaling a new strategic direction. The executive team is now ably led by David H. Watson, who serves as President and Chief Executive Officer, alongside Joshua S. Bauer, the Senior Vice President, Chief Financial Officer, and Treasurer.
The new core team.
Yes. The company has also made strategic leadership additions at the subsidiary level, notably appointing a new CEO for SMC Infrastructure Solutions in November 2024, with a clear mandate to expand its market presence and capitalize on new opportunities. The recent retirement of founder Rainer H. Bosselman and the planned orderly transition of the CFO role truly mark a new era for the company's leadership, suggesting perhaps a move towards more institutionalized management practices.
So with these leadership changes, how closely are the interests of this new management team aligned with those of the shareholders? Is there, skin in the game?
That's a crucial question. In terms of insider ownership, executive officers and directors as a group directly owned approximately 4.1% of the company's outstanding voting shares as of January 31st, 2025.
4%. Is that high or low?
It's not a controlling stake, certainly, but it's significant enough percentage to suggest a vested financial interest in the company's long-term success. This level of ownership helps to align management's decision-making with the interests of broader shareholders.
Makes them think like owners.
Hopefully. It incentivizes them to drive sustainable value creation rather than just short-term gains.
Okay. What about oversight? Governance.
Argan also has established robust corporate governance structures to provide oversight and manage risk across its operations. The board of directors has established key committees, including an audit committee, which plays a vital role in overseeing management's cybersecurity program, an increasingly important function in today's digital landscape.
Very important, though.
And a responsible business committee, which helps set strategy on crucial environmental, health, safety, EHS, and other public policy matters.
So formal structures are in place.
Yes. The company utilizes stock plans, such as its 2020 stock plan, to provide share-based awards to its officers, directors, and key employees. This practice helps to further align their incentives directly with shareholder value creation, ensuring their personal success is tied to the company's performance.
Tying pay to performance.
Exactly. And historically, the company's executive compensation proposals have received strong support from shareholders, with approval rates consistently averaging over 90%. Which indicates a high level of confidence in their governance practices from the owners themselves. Hashtag outro.
So what does this all mean for you, the informed listener? We've taken a deep dive into Argan, Inc., a truly compelling company positioned right at the crossroads of immense energy demand and the complex ongoing energy transition.
Yeah, to recap the key takeaways, Argan is a highly specialized builder of critical power infrastructure. It's strategically positioned in both natural gas, which is proving crucial for immediate grid stability, and in the rapidly growing renewable sector.
The dual strategy.
Yeah, right. It boasts that exceptional fortress balance sheet with zero debt and substantial cash, providing a unique competitive advantage. The company is currently riding a powerful supercycle of electrification, largely driven by the explosive growth of AI data centers, the accelerating adoption of EVs, and that resurgence in manufacturing onshoring.
Huge tailwinds.
Huge tailwinds. This confluence of trends has led to a record-breaking $2.2 billion backlog, providing strong revenue visibility for the next several years. However,
Always a however.
always, as we've seen, it also faces significant risks inherent in fixed-price contracts, persistent inflation, supply chain disruptions, and labor shortages, as unfortunately exemplified by the Kilroot project loss.
Real challenges to manage.
Definitely. And the market currently values Argan at a premium, reflecting high expectations for its future execution and its ability to capitalize on these powerful tailwinds while navigating those challenges.
It's a story of powerful, almost generational tailwinds meeting real-world, intricate operational challenges, all wrapped up in a company with a truly unique financial profile. They are, quite literally, building the foundational structures that make our modern, interconnected world possible, while navigating an incredibly dynamic and demanding environment.
This raises, I think, an important question for all of us as we think about our energy future. As the demand for electricity continues to surge, driven by all these factors we discussed, how will companies like Argan balance the urgent need for reliable, dispatchable power, the kind that keeps the lights on, and the data centers humming 24/7, with the equally pressing imperative to accelerate the transition to sustainable energy sources?
That's the big balancing act, isn't it?
It really is. And what role will that unparalleled zero-debt balance sheet continue to play in providing the resilience needed to navigate the inevitable disruptions and opportunities ahead in this transition?
Indeed. A lot to consider as we watch the future of our power infrastructure unfold. We hope this deep dive has given you a robust, nuanced understanding of Argan and Inc. and the dynamic world it operates in.
Hope it was useful.
Thank you for joining us on the deep dive.